Some of the world's biggest and best investors have a secret: alternatives, also known as alts. This includes real assets, private equity, hedge style strategies, and the stuff that never makes the headlines but quietly drives returns. Today, we're pulling back the curtain on alts and how they may fit into a smarter, more resilient portfolio. Stick around. Joining us is the queen of alts, Shana Sissel, founder and CEO at Banríon Capital Management. Shana, great to see you. Thanks for being here.
I appreciate you inviting me, Ron.
So let's talk about the role of alternatives, also known as alts, today. So how do you define alternatives inside a modern portfolio, especially as traditional 60-40 dynamics continue to evolve?
There's a lot of discussion, and I get pulled into it about the death of the 60-40. And I don't think the 60-40 has died. I think it's evolved. No different than we saw in the early 2000s after the tech bubble burst. And we saw an evolution there. Before that, fixed income was not as much of a priority. And I don't know that most people can remember and appreciate how much of a transformative period that was for portfolio construction. And we're seeing that right now with alternatives. Alternatives are a lot of things. In fact, alternatives as a bucket is sort of a catch-all category. And many things in alternatives have different roles and play different roles in a portfolio, and not necessarily in a specific alts bucket. And we'll get into that, I'm sure. But alternatives are basically anything that's not traditional owning of a stock that's publicly traded or traditional owning of a bond that's publicly traded. It is irrelevant what that wrapper is that you are getting it in, whether it be a mutual fund or an ETF or a closed-end fund, or you're buying individual securities. But when it is beyond that, it's an alternative. And that's a really large grouping. And that's why I say it's more of a catch-all than anything else. It's not really the greatest definition, but it is what it is.
Yeah, investor interest, as you know, in alts or alternatives has surged. So what do you see is the biggest factor behind that shift? Is it risk management? Is it return enhancement, or something else?
So again, I'm going to reference the early 2000s period because, again, I think when people think about, say, a firm like PIMCO, right, we just default, it's been around forever. It's like Fidelity. It's like Capital Group. It's like BlackRock. And the fact of the matter is that's actually not true. PIMCO became PIMCO coming out of the tech bubble because of an increased focus on fixed income and a need for improved fixed income access for all investors. Prior to that, the only way you could really get fixed income was going and buying a physical bond. There was actually a U.S. government website you went to purchase U.S. Treasury bonds. You didn't do it necessarily through a mutual fund or anything of that nature. And I think the same is true with alternatives. And just like fixed income is now commonplace and we don't even think twice about it, that wasn't true 25 years ago. And in 25 years, we'll probably feel the same way about alts. We're only really not even 10 years or 20 years into this revolution of alternatives. And what I mean by that is the reason there's such an increased interest in alternatives, broadly speaking, is because you can actually access them now. Prior to 2007, it was very difficult for the average investor to gain access to strategies that fall into the quote unquote alternatives bucket. They didn't exist unless you had $1 million and met certain regulatory hurdle definitions in order to invest. It was truly the game of the rich. That's it. But 2007 was a game changer. There were rule changes by the SEC that provided the roadmap to bring alternatives into products that were more accessible to the everyday investor. And it took a little bit of time for that to kind of work itself out. You know, initially, a lot of firms launched mutual funds right off the bat, but gathering assets was difficult, particularly in a market that went straight up in 2009. So they never really gained any traction. With the advent of active ETFs and other products, interval funds and the like, it is now a lot easier to access these products. And a lot of that is why you see increased interest, because you can be interested because you can invest. It wasn't like that before.
Yeah, and even level playing field. So when you evaluate alternative strategies, and I know that you're good at this, what are some of the criteria that matters most? Is it structure? Is it liquidity? Is it manager skill, or something else?
So it's all of those things. And I think one of the things that is not as appreciated in the evaluation of these products is structure. Liquidity is always a focus. Everybody talks about how alternatives have different liquidity, and that's largely a result of structure, but it goes beyond that. So the average investor is very used to what we like to call evergreen, meaning products that are always open and always available to put new money into. They are ongoing and they don't have like a limited window of investment opportunity. There are areas, and it's not all areas of alternatives, that have what we call drawdown products, which are limited windows of investment, vintages, if you will. Think about it as wine, right? They start on a certain year, they close, and then the vintage is the year that they close and they start putting money to work. But this is an important thing to understand, because sometimes the vehicle is necessary for the type of investment that is being done. And I'll use private equity as a good example of this. Private equity should not be done in an evergreen structure, because to do that means you have to be able to put money to work immediately, and you can't have discernment and selection of the deals you want to participate in. And in that type of environment, the likelihood that you won't be able to participate in the best deals or be as selective is as high if you try to do it in an evergreen format. The other problem is most private equity firms that have a strong track record of managing private equity have never functioned in an environment where they are evergreen. And so they don't know how to manage cash either.
Yeah. So when you say evergreen, just give an example what you mean by that.
Yeah. So what I mean by that is it's a fund, like a mutual fund, right? You can put money into it at any time. There's no date at which it closes and you can no longer invest. Evergreen is an ETF, a mutual fund. They're evergreen. If I invest in it today, great. But if I wanted to invest in it 10 years from now, I could. In private equity and what we call drawdown funds, there's a period of time where they look and establish interest and commitments to invest in the product, and then they close the commitment window, and then they call the commitments when there's something to invest in. But once the commitment window is closed, it's closed. You can't then decide you want to be in that product.
Yeah, venture capital funds, I think, operate in a similar fashion.
Venture capital does it. There are some real estate funds that do it. Private equity is the biggest player in what we would call drawdown or capital call. Evergreen is harder to do in those functions because the actual environment changes so rapidly. It's very hard to really compare. And that also gets to the second most difficult thing when it comes to alternatives. As I noted in the beginning, this is a catch-all category and it's not all the same. So the way that you evaluate and the metrics that you look at for, say, a private equity fund that is a drawdown fund that has a limited window of investment versus an evergreen or product that's always open or that's using and investing in public securities like a hedge fund would have other metrics. And some of the metrics that are used in evaluating, say, private credit or private equity are not easy to understand and not as most regular investors, everyday investors aren't familiar with things like return on invested capital or IRR, which is the key metrics you would look at for something like a private equity fund. And so those things make evaluating these type of investments more difficult if you aren't familiar with or you aren't highly experienced in the space.
Shana Sissel with Banríon Capital joining us. If you're an advisor or investor looking at alts, get in touch. Go to banrioncapital.com. As you know, Shana, alternatives come with trade-offs. So how do you help advisors and clients sort through that and also set realistic expectations?
I'm going to toot my own horn here a little bit because I'm actually quite proud of this. I've spent the vast majority of my career in manager research, meaning that the vast majority of my career I have spent evaluating people who manage money, not managing money myself in the sense that I'm not selecting stocks or any sort of security. I'm deciding whether or not to invest in a manager who does that. And in doing that, I've realized that most firms that do quote unquote manager research are not necessarily looking at it in a way that an advisor or an individual investor would look. They very much are coming at it and continue to come at evaluation as if the person reading their work is an institution who has a very different mentality and goal than an individual investor. And so for that reason, when we evaluate these types of products at Banríon, we really don't focus on making any kind of rating. And the reason why is because there's so much nuance across even broad categories like private equity and private credit that you cannot compare across like you can with, say, large cap growth or intermediate investment grade bonds. There's so much nuance. That's true as well with hedge fund strategies. They're not. And I'll give private credit as an example, and then I'll use hedge funds as another example because I think they're important. Private credit, for example, there's upper middle market credit, which is an entirely different world than lower middle market credit. They are not the same. And there's nuance within those categories, especially in lower middle market, where you might have much more nuanced and niche approaches. So to compare a lower middle market manager to another lower middle market manager, say one is investing in only SaaS or offering credit only to SaaS-based technology companies, and the other is doing it to consumer products. You can't compare them because they're so drastically different. So we don't attempt to do that. In hedge funds, same idea. Let's talk about long short. The amount of long short a manager is, and we talk about net and gross exposure all the time, matters. So a long short manager that is closer to neutral, and so maybe gross 150, meaning they're 100% long and 50% short, versus a manager who leverages and maybe is 400% gross, meaning 200% or maybe 250%, 150%, whatever, exposure. Those two managers are apples and oranges and cannot be compared to each other. They're doing very different things, and their exposure and the way they will impact your portfolio and a return, correlation, and risk are quite different. So you can't compare those either. So at Banríon, when we do any sort of evaluation of these strategies, we don't seek to decide who is best at any of it. We seek to help our clients, our financial advisors and their clients, understand how these things might fit in a portfolio in terms of risk return, and in terms of diversification and correlation. And then we focus on what conversations should be had before making the investment. So that can be, I like to say, it's our flag report. Green, red, yellow, it's just flags. But it's about having the right conversation. So for example, if it is a drawdown fund or a fund with a limited liquidity window, we will talk about liquidity budget, establish a liquidity budget, talk to your clients about liquidity budgets, because this will come up. If there's potential tax consequences or distributions that are unusual, we will flag that. It may not be a bad thing, but it's a conversation that needs to be had to avoid confusion. And also understanding the implications on what the risk of the portfolio are, all very important things. So that's what we focus on, not whether or not this is the best private credit fund that ever existed. Rather, is this a private credit fund that's a good fit for your client? based on their risk profile, their liquidity tolerance, and so on and so forth. And that's how you have to approach alts. It is not like you would approach more traditional areas of investing.
So which areas within the alternative space, you already mentioned a couple, private credit, real estate or real assets rather, hedge fund strategies, buffered products, or maybe some other area within alts. So which of these maybe right now do you think offers some compelling opportunities from a portfolio construction perspective?
I think for the last several years, we have spent a lot of time talking about private equity and private credit venture capital. And it makes sense, right? Because all the rage is AI. AI is rather immature, and most exposure to anything in that space is through private markets, through venture capital, private equity. Private credit has been a much more impactful area in capital markets in general because credit markets changed after the great financial crisis. And so private credit became a far more influential and important part of credit markets in general. So that's been the area of focus. What hasn't been paid attention to really at all, and it's shown because these products have struggled to raise assets, but I think deserves focus today are the types of strategies we would have traditionally said are hedge funds. I want the audience to walk away understanding that hedge funds is the most ridiculous term. It's not really a product. Hedge funds is just a approach that hedges, and it can be in different vehicles. And today, hedge funds, hedge strategies are available in ETFs, mutual funds, interval funds. And hedge funds are not just the private placements and the tiger cubs of the world that they once were. And when we say hedge funds, we think of the, evil guys who made all the money on people. And we forget that hedge funds is by definition an attempt to use a hedge strategy and often have leverage and have different packages. They are broadly available today. They are very poorly categorized. I have definitely gone after the industry on the fact that it is very hard for the average investor to really differentiate across hedging types of strategies. Hedged equity is long short, where people are actually going long and short individual securities. And it's also strategies that use option contracts. And those things are very different and play different roles and have different risk profiles, but they're categorized together. And I think as an industry, we're doing a disservice, but I think that more attention should be paid on these strategies because they are actually the most diversifying. And as we go into this next market cycle, I think understanding how they can improve volatility metrics of a client portfolio and the diversification is imperative. And when you see any research talking about alts, that's the kind of strategy they're referring to. It's not private equity and private credit. Those actually aren't diversifiers at all. They're just a different way to access what is now a larger market than the public markets, which is private markets.
Yeah, and that's important too, because financial markets, as you know, have become more concentrated. Obviously, the Mag 7, we all talk about that, but just the market in general. You look at the number of stocks, compared to where it was 25 years ago, we have less and less publicly traded companies that are going IPO or coming to market. They're just skipping right over small cap, mid cap, going to mega cap. So it's like you said, a much different market, and investors want true diversifiers. So let's talk finally about advisors. How can they find and deploy the WisdomTree Banríon Select Model Alternatives portfolio? Talk about that, because I know you're excited about that.
I am. Back in November, I was able to talk to our friends at WisdomTree, and they approached us about helping them really put together a strong alternative ETF offering. The ability to create alternative portfolios is an art. And there's only a few folks, myself being one, that have been doing it for a really long time. In fact, I've been doing it since it became possible to do it, which started in 2007. And it's possible to do it, but you really have to understand the space. And all the things we just talked about are problems. And I thankfully have the experience to help discern across a lot of this stuff and see through it. But the goal was to provide the best possible portfolio of alternatives to optimize the risk return benefits and the diversification benefits. So WisdomTree partnered with Banríon to create an SMA that allows for advisors to have an optimized portfolio. And I'm quite proud of the portfolio and the track record that it brings to the table. And you can find it on both Schwab and Fidelity today through the SMA programs. It's implemented through a company called Chorus. And so you have to look for Chorus, not WisdomTree or Banríon. And I think that's important. But it is an SMA, and it just invests in alternative ETFs. So it includes everything from long short equity to crypto to fixed income arbitrage, private credit. And the goal here is to create a portfolio that will fit in nicely to what is the evolution of the 60-40 and really improve the outcomes for clients in a way that makes sense and that can be consistent. And so I'm really proud of it. Like I said, Fidelity and Schwab's SMA programs, it's available there. And if you'd like more information, you can reach out to Banríon. And Banríon also has a great white paper that's available through our website that kind of talks about a lot of the things we just talked about today. But I'm really excited about this. It's the first of its kind opportunity. And I am excited to be able to bring my expertise to everyday investors.
Well, Shana, great insights on alts. Keep up the good work, and we'll see you soon.
Thank you so much for having me, Ron.
To learn more about investing in alts and alternatives, I've got links to Banríon Capital in the description section below. Get in touch. I'm Ron DeLegge with ETF Guide. We'll see you on the next episode. Thanks for watching.